Hello and welcome back to Earnings Edge right here on NDTV Profit. We're now being joined by the management of Lumax Auto after a stellar quarter, in the previous one as well as following up in this one as well. We're now being joined by the management. Mr. Anmol Jain is joining us. Mr. Jain, a very good morning to you and thanks so much for joining in. Let me first start off with the order book, because that's been one of the key aspects for Lumax Auto, as well as giving very strong visibility in terms of revenue going forward. I think this quarter it's 1,500 crores. Last quarter it was roughly about 1,300 crores. So could you just talk us through what's been the incremental order wins in this particular quarter, as well as how much are you looking to execute in FY26?
So thank you, Puneet. It's very clear that, is in line with our growth strategy of the 20% CAGR every year. I think the order book is just a follow-up of that. This quarter, there were many new products which went into SOP, and then there were new wins as well. So currently, yes, we are about 1,500 crores as an order book. I do believe about 40% of this entire order book rests in the future and clean mobility space, which is where strategically the company is trying to position itself. Have more products which are towards this space, higher content per vehicle, better margins going forward. So this should actually orbit us strategically into a very different organization in the coming years. So 1,500 crore order book is a healthy one, continues to grow. It is pretty diverse across different product verticals. Of course, the majority of this order book sits in the advanced plastics or the interiors vertical. In terms of revenue, I don't think more than 8 to 10% of the revenues of this order book will come into FY26. A large part of it, almost 40%, comes in FY27 and another 40% in FY28. So that's just to give some color on the order book.
And Mr. Jain, just a follow-up, if you can just give us some perspective on what kind of products are you actually selling within the future and the clean mobility space, because that seems to be one of the key strategies for you going forward.
So absolutely. So when we talk about clean mobility, there are largely two verticals. The EV models, I'm talking about the pure EV, whether it's a four-wheeler or the two-wheeler. For us, it falls under the clean mobility space. Also, an emerging sector for us was the CNG. And that's the reason why strategically we took a bet inorganically to get into the CNG space. We do believe that the CNG space will continue to grow in the passenger vehicle segment. The major OEMs there, Maruti Suzuki, Tata Motors, have already announced a big aggressive push towards CNG for the next few years. Also, with the CAFE 3 norms coming in, CNG continues to play a vital part to balance out the emission norms. So clean mobility encompasses for us largely electric vehicles and the CNG vehicles. And in terms of future mobility, it talks about a lot of electronification, sensors, human-machine interface, which multiple product lines under the mechatronics product vertical fall under this category. And again, as we go forward, we will also be developing a software integration center, which will then further take the next steps in terms of integrating all these products and selling it as a entire end-to-end solution to our OEMs. So these are primarily the few areas which we classify under the future and clean mobility space.
So Mr. Jain, essentially, roughly about 51% of your revenue is coming from the advanced plastics, segment in this particular quarter, and that's largely been what it has been over the last few years. But it has been decreasing because the increase in alternate fuel segment, that's already 9% of your revenue in this quarter, as well as mechatronics, as you mentioned, as well as you're adding more software-defined, solutions as well for cars. So would that be safe to say that with this strategy in mind, Lumax will be moving away from just being a supplier of lighting products to essentially becoming a technology first as well as electronic first manufacturer, and hence with all that we've seen in EV specifically, because Mahindra is also one of your key customers, that will be one of the key strategies going forward?
So clearly, Puneet, our midterm plan encompasses, let's say, to achieve this 20% CAGR, there are few key growth engines apart from the different 9 to 10 product lines which we cater to. Clearly, the advanced plastics or the interior space will continue to grow. And there, the growth is not largely coming just by volume organic growth, because we do know the industry currently is facing headwinds, and that business is largely dependent on one OEM, being Mahindra. But the value content per vehicle, with the electronification, with the HMI, integrating things like ambient lighting, having a stronger software push, integrating into different products in the interior space. So that's one growth driver for us within the advanced plastics. Also, the second vertical is the mechatronics. If you look at Q1, we've almost doubled our mechatronic revenue on a year-on-year basis. And the growth in mechatronics will continue to outperform some of the other product segments, largely because of course, a small base. But as I said, a significant part of the order book rests under the mechatronics in terms of the future mobility. The third segment for us, of course, is the CNG, which, as I mentioned already, is an inorganic growth strategy. And we have very aggressive plans to grow that segment. And lastly, the aftermarket segment, which continues to be an integral part. Almost 10% of the consolidated revenues comes from that. Q1, again, we saw a pretty strong comeback in terms of a 15 to 16% growth on a year-on-year basis. And again, these primarily are the four growth engines, which will not just take us forward with the whole 20% CAGR objective, but also position the organization to a very different, like a tier 0.5 with a software play and giving end-to-end solutions for our OEMs. So that is the play at large over the next 4 to 5 years as a midterm strategy.
Got that, Mr. Jain. So just if you can put some numbers. So right now, roughly, I mentioned advanced plastics is 51. The growth will continue there, as you rightly mentioned, with ambient lighting amongst other products. So do you expect that this share should rest somewhere around 40 to 45%, with mechatronics also almost growing almost at the pace that it is? Somewhere around FY28, do you see that the mechatronics division will be around 15 to 20% of your revenue, and with alternate fuels as well, closing on 10%? So do you think that 1/3 of the business will be resting with those two new segments?
So I believe the advanced plastics will continue to grow at maybe a 15 to 20% CAGR. So clearly, I don't see a dramatic shift in the percentage of the pie. I think it will continue to be anywhere around 45 to 50, 55% of the total consolidated revenues. Yes, the CNG vertical will grow. I wouldn't be surprised if both CNG as well as mechatronics over the next 2 to 3 years contribute about 10% each to the consolidated revenues. And again, I'm talking based on the order book which sits at hand currently. I think the other muted growth will be in the structures and control systems, where I do envisage a single digit, maybe a 7 to 9% CAGR. So that would still continue to give about 10 to 15% of the total consolidated revenues. So this is again, a broad aspect of the contributors. Aftermarket will perhaps grow beyond the 10% to maybe around 15% to the total kitty. So again, a very diverse product portfolio, where clearly each of the verticals will be anywhere between 10 to 15%, and the advanced plastics will continue to have the lion's share at about 45 to 55%.
Got that, Mr. Jain, and thanks so much for giving that clarification as well. Let me just ask you, for this quarter, we saw some impact on margins because of price correction. Do you expect that to reverse in Q2, or do you see that within this year that should play out?
No, I think it was I would not say it's a price correction. It is actually a price actualization. A lot of times when new products are developed, it takes time for those price settlements to be agreed upon with the OEMs. And again, this is largely for the BEV models of Mahindra, where it was the first time for Mahindra as well getting into this space. So the settlements have already been done. So it is just a kind of a Q1 impact which will come into Q2. So it's a one-off case. It's not a routine nature of the business. But in Q2, you should see the corresponding effect of quarter one come into play. And I think, again, for the whole year, we still remain very optimistic to maintain the EBITDA margins between 14 to 15%, as was the guidance given earlier and as was what was achieved last year as well.
And Mr. Jain, just one very quick question on the content per vehicle for both four-wheelers and two-wheelers. Given your strong order book and the comments that you made across segments, it does seem that the four-wheeler content per vehicle will continue to increase. If you can just give us some perspective on what you're doing for two-wheelers as well, because that currently sits around 22 to 25,000 per content per vehicle. So where do you see both those in the medium term, of course, because the order book is 80% coming from FY27 and 28. So where do you see both these numbers going forward in the next 3 years?
I think the content per vehicle will continue to increase in both the segments. Of course, passenger vehicles will have a larger play, purely again based on the technology involved in terms of the software integration involved. And today, if you see, I think about more than 50% of the revenue pie comes from the passenger vehicle space. So the contribution per vehicle or the value content per vehicle will continue to increase in both spaces. We've already launched certain IVI products, certain throttle position sensors for the two-wheelers. And again, with that, we do expect to take this wallet share across different OEMs in terms of these new product offerings. But I do believe that in both segments, the content per vehicle over the next 3 to 5 years should see another maybe 10 to 20% upside.
Well, that was the management of Lumax Auto. They've seen the content per vehicle increase by 5 times over the last 5 years and still seeing a stellar growth going forward as well.